Hello everyone, welcome back to our channel. This is Vaibhav Bansal. Today we are going to complete our transfer pricing chapter with full-fledgedly and with important all the concepts. So today's session is going to be very important, the ultra important session of your transfer pricing chapter. This is the most important part of your transfer price. Now we are going to start with the advanced pricing agreement. As the name suggests, it is an advance. It is an advance. There is some procedure which is in advance to determine the price of the agreement. Which there is a contract between the assessee and the CBDT, the government, in advance at what price the assessee should transact with their associated enterprises. The determination of the price or the method from which the price will be determined will be agreed upon and will be agreed upon by the assessee and the CBDT in advance for the future transaction. This is known as advanced pricing agreement. An assessee can go to the department and say, I want to sign a APA, the advanced pricing agreement with the government of India, so that I can easily transact with the associated enterprises without having any fear of getting my case into the scrutiny, and they are adding back the ALP to my income. So this is what advanced pricing agreement is. Now listen to it very carefully. Assume that on the 10th August 2020, an assessee named VV Limited applies to the CBDT to enter into an advanced pricing agreement in order to ascertain the arm's length price of the royalty owned by the US company. The ALP determination this has been requested. The ALP determination under the APA is determined for how many years? The 5 years. It determined for 5 years. If you are entering into an APA, then APA will be for the 5 years. Is it clear? APA cannot be more than 5 years. It will be conducted for the 5 years only. Such agreement must be approved by the central government, and it cannot be entered for more than 5 consecutive years as specified in the agreement. Whatever the period is covered under that agreement will be specified under that agreement only. Now, what is the fees for the advance pricing agreement? If you are going to the CBDT and asking for that, I want to sign an agreement with the government of India or the CBDT. So what is the price? What is the price that you have to charge? So for the value up to 100 CR, if your transaction value, if you are the assessee is transacting with their AE, whose aggregate value, whose international transaction is up to 100 CR, then the fees is 10 lakhs. For more than 100 CR but up to 200 CR, the fees is 15 lakhs. And but if your transaction is more than 200 CR, the aggregate international transaction that you have done with your associated enterprises is more than 200 CR, then the fees is 20 lakhs only. Now, after filing the application fees, 10, 15, and 20 lakhs. After filing the application fees, can the VV Limited, the Vaibhav Bansal Limited, can they withdraw its application? Yes, they can withdraw its application, but the fees will not be refunded. Whatever the fees you have paid, 10 lakh, 15 lakh, or 20 lakh, whatever the fees you have paid, that will not be refunded in any case. You want to withdraw it, you withdraw it, but the fees will never be refunded. The fees will not be refunded. Now, see it. I said value for international transaction. I didn't say SDT. I didn't say SDT means specified domestic transactions are not covered here. That's why the next line says APA cannot be entered for the specified domestic transactions. APA cannot be entered for the specified domestic transaction. So, sir, as there is a safe harbor rules for the specified domestic transaction, there is also safe harbor rules for the international transaction. Whether there is any other provision apart from APA, whether there any other provision for the specified domestic transactions, then no, there is no other provision for the specified domestic transaction apart from the APA. I hope this is equally clear to you all. Now, all this thing whatever is written, it is an example form. We have covered under the effects of APA. The effects of APA is covered here. You can refer this only. It is just a duplication. That's why I just made it clear. It is the effect of APA. Here only we will complete everything. So it is not that I have left anything. It is just we are completing here only. Mm. There is a rollback provisions for the APA as well. What is the rollback provision is? If you have applied for an advanced pricing agreement, if you have applied for the advanced pricing agreement and you want that for my previous year, I just also want to adopt the same approach as adopted in the APA. What it says, in the current year, for the future year, for 5 years, I have entered into an APA. Now, the provisions are equally may be beneficial or may not be beneficial to the assessee. But the assessee want that there should not be any litigation against me. There should not be any AO's scrutiny order. There should not be any reassessment orders. I just want to be apart from these kinds of orders or these kinds of litigations. I do not want to give fees to the CA. I just want whatever approach you have adopted in the APA, whatever price you have said that it will be your APA, after determining all the factors, they said this is your pricing that on which you can transact with your associated enterprises. But the what the assessee is saying, the same approach can you adopt it for the later for the previous years as well? That the previous year that has been passed, I have already filed the return. I have already filed the form 3C EB. Everything has been filed. Can you please adopt the same approach for those years so that my case can be closed or may not be open in the future years? Can be done so? So the government said, yes, there is a rollback provisions, but that rollback provision is for 3 years. It's for 3 years. If you have to come, you have to you come. If you want to come for all the years. Otherwise, you don't come in this rollback provision. So the agreement shall contain rollback provision in respect of an international transaction subject to the following, namely, the international transaction is same as the international transaction to which APA applies. The same international transaction on the same international transaction on which APS applies, can the rule provisions apply? Only to those transactions on which API applies, the rollback can also be applied. The return of income for the relevant rollback years has been furnished by the applicant before the due date of filing of return. Before the due date of filing of return, can you file the belated return? No. If you file the belated return, this rollback provision is not applicable. You have to file the applicant have to file before the due date of filing of return, before the due date. Now, the report international transactions have been furnished in section 92E that I have said from 3CEB. Yesterday we have cleared that. Okay. The applicability of rollback provision in respect of an international transaction has been requested by the applicant for all rollback years in which the said international transaction has been taken by the applicant. What I said, if you want to come for the rollback, come for all the years, all the 3 years, come for all 3 years. We will not allow you to come for a year. Again, you just leave the rollback provisions, then again apply. If you want to apply it, applied uniformity with all the 3 years, all the three past years. This is the only point this is saying. Now, what it says, the applicant has must file an application, because for the AP also you are filing an application and paying the fees. For the rollback also you have to file an application with the fees. What is the application? Application is in form 3C EDA with the fees of rupees 5 lakh. 5 lakh. This form is need to be learned? No. This fees is need to be learned? Yes. Now, what it says, non-applicability of rollback provisions. There are certain conditions when the rollback provisions will not be applicable. What it says, the determination of ALP of the said international transaction for the said years has been subject matter of an appeal before ITAT, and the ITAT passed an order disposing such appeal at any time before signing of the agreement. If before signing of the agreement, if the matter is pending and the ITAT has passed an order before signing the agreement. If any of these conditions is fulfilled, if the ITAT, see, listen it to very carefully, it says ITAT, not income tax, any other authorities, not CIT appeals, not DRP, no, not at all. Just said ITAT. If there is a matter pending, a matter subject to the appeal before ITAT, and ITAT has passed an order before signing of the agreement, then the rollback provisions will not be applicable on it. Now, the application of rollback has effect of reducing total income or increasing the loss. if because of the rollback provisions your earlier filed income is reducing the total income or increasing the loss. On these cases, reducing the total income or increasing the loss with effect for the rollback provisions, on this kind of time, transfer pricing chapter is also not applicable. If your total income is reducing or you're increasing the loss, on that on it transfer pricing provisions are also not applicable. If the transfer pricing provisions is not applicable, then how then the roll provisions can be applicable? Rollback is also part of the transfer pricing. If the transfer pricing provisions are not applicable, if this whole chapter is not applicable, then how the rollback provisions are applicable to them? They cannot be applicable of the applicant as declared in the return of income of the said year, if there is any effect of reducing the total income or increasing the loss. I hope it is very much clear to you all. Now we are moving towards the effect of APA. Now, what the effect to APA says? See, if the return of any previous year to which APA applies has already been furnished before the due date of such APA, before the date of such APA, like the APA has been entered today, but the return of income has been filed earlier, the assessee shall furnish a modified return. You have to modify your return with effect to the with effect to the agreement. Whatever the agreement says that this is the transfer price. So if you have shown any other transfer price, then you have to modify your return within 3 months from the end of the month in which such APA was entered. Like today it was entered, so we will come to the end of the month like the 30th September, and from that we will get the 3 months, that October, November, December, that is the 31st of December 2024. I have to file what? I have to file the modified return. This is the effect of APA. Whatever the APA is entered, now this is the effect of that you have to file what? Modified return within 3 months, and such return shall be deemed to be furnished as under section 139. So whatever the return is, it will be deemed to be furnished under section 139 itself. Now what it says, if on the date of filing of modified return, the assessment or reassessment for such year is pending. If on date of filing of the modified return your assessment or reassessment is pending for such particular year on for which you are filing the modified return, then AO shall consider such APA and modified return in completing the assessment or reassessment. So the AO shall also comply with the APA provisions that has been applicable before passing any order like the assessment or reassessment order. Before passing any type of an order, he will get the sufficient time as well. What time he will get, we will study in just here only. And before that, he will consider all the APAs and the modified return that you have filed with that. Now, time limit is otherwise available for completion of assessment or the reassessment shall be extended for by 1 year. The time limit shall be extended by 1 year to the AO. Now, if without waiting for the modified return, that is before expiry of the time limit of the modified return, I have to file the modified return till 31st of December. But suppose the AO have filed, AO have passed the order of assessment or reassessment on or before 31st of December 2024, like on say in on November, say in November he has passed the assessment or reassessment of any year to which APA applies has already been passed. In such a case, to give effect to of APA, AO shall pass an order modifying the total income of the relevant assessment year determined in such assessment or reassessment having regard to in accordance with the APA. If the such order has been passed, so the AO has to modify his order according to the APO. Such proceedings must be completed within 1 year from the end of the year of the filing of modified return. Is this point clear? Now, what I said, as the APA is not applicable for the APA is not applicable for the as the SDT, the specified domestic transaction, then how can the rollback provisions effect of APA will be applicable for SDT? They cannot be applicable for the SDT. That's why it said it have been noted that the entire discussion on APA is relevant only for the international transaction and not for SDT, specified domestic transactions. I hope it is very much clear to you all. This has already been covered in under lecture number 2 of this chapter. Okay, the major part till here is already been covered. This part will be covered today. Okay, this part will be covered today after completing all the rest topics. Now, secondary adjustment under certain circumstances. It is under certain circumstances. Under certain circumstances. And what are those circumstances? Let us understand. See, this is the 92CA understanding. What it says. Suppose there is an assessee named VV Limited. Okay, the sale consideration is 200 CR. The ALP, we have transferred something. The VV Limited has transferred something for the 20, for the to the AE on rupees 200 CR. But ALP, the market price is 250 CR. So it is 200 CR, or they have what is the market price? 250 CR. So the adjustment of 50 CR that you have taken less from your AE, the adjustment of 50 CR is called as primary adjustment. Whatever you have seen by all the six methods, the most appropriate method, by applying those most appropriate method, you will get what? ALP. And for ALP, you will get from those six methods whatever you apply as per the most appropriate method, and whatever you have saved, we will compare it, and whatever the adjustment is known as the primary adjustment. It is known as the primary adjustment because we have to do secondary adjustment. So first we need to understand what is the primary adjustment. So it is the primary adjustment which you do after applying the formulas of the most appropriate method. Okay. Now understand this. It is very important. Now the government is saying this is the primary adjustment. This is a kind of a loan. This is a kind of a loan that you have given to your AE. This is the kind of a loan. For the consideration of 250 CR, you just taken to 200 CR and provided a 50 CR loan. Have provided the 50 CR loan to your associated enterprises. Is am I clear? Very much clear. So what it says, the loan portion will be repatriated in India. The loan portion will be repatriated in India within 90 days. Within 90 days, the loan pattern should be repatriated in India. Now that 50 CR should be repatriated to India within the 90 days. The government is saying that loan of 50 CR that we are deeming that you have passed on to your AE without any interest. So for that loan, you must be repatriated. The 50 CR, the loan amount should be repatriated in India within 90 days, should come back to India within 90 days. If you take back your loan amount, that the 50 CR repatriated to India within 90 days, then okay, you are a good boy. But if not, if not, then it will be deemed advanced to AE. It will be deemed advanced to AE. And on that advance, what we need? We need interest. So the government is saying that advance must be given in interest. So what is the interest? Suppose your transaction is in Indian currency, or maybe your transaction can be in the foreign currency, whatever the currency is. So see, if your Indian currency, suppose first is foreign currency. For foreign currency, you have to take the LIBOR rate. You have to take the LIBOR rate. The LIBOR rate for 6 month money lending as on 30th September of the relevant previous year. What it says, for 6 month money lending as on the 30th September RPY, the relevant previous year, what it says, it means that if we lend money on 30th September for 6 months, if we lend money on 30th September for 6 months, what is the rate of interest under the LIBOR? London Interbank Offer Rate. LIBOR full form is London Interbank Offer Rate. Okay. For LIBOR for 6 months. If on 30th September, if I lend money for the 6 months, then what is the interest rate of interest that we have to charge? Take that interest plus do 3% on it. The government is saying do ad hoc 3% on it. Whatever the rate comes, that will be the interest. On that interest, on that basis, you will pay the interest to us. On that basis, on this calculation, you will pay what? Interest to us. This is whole point that government is saying. Second, for the Indian currency, if the transaction has happened into an Indian currency, then the government is saying SPI rate for 1 year money lending from April 1 of the relevant assessment year. So what it says SBI is issuing the rate, the list in the April. So the government is saying you take from the 1st April, if we lend money to someone for a 1 year, for a 1 year period, what is the rate of interest? The government is saying take that SBI rate of interest. Okay. We are taking and add ad hoc 3.25%. Add ad hoc 3.25%. Whatever the interest comes, this is the rate of interest at which we will charge you the interest. Okay. Now, if the primary adjustment does not exceed 1 CR, if the primary adjustment does not exceed 1 CR, or the primary adjustment relate to the previous year 15, 16, or before that, if the primary adjustment is below 1 crore rupees, or the primary adjustment relates to the previous year 15-16, means the assessment year 16-17 or before that, then the secondary adjustment provisions shall not be applicable. The provisions of secondary adjustment shall not be applicable. So you have to see whether the primary adjustment is exceeding 1 CR. If not, so do not apply the secondary adjustment. I hope this is very much clear to you all. Now, coming on to the limitation of interest. What is the limitation of interest? Limitation of interest is a thin capitalization. It is also known as a thin capitalization. What it says? Now, here our assessees are maybe Indian company or foreign company having PE in India. What it says? Your assessee is either Indian company or any foreign company who's having PE in India. Okay. Now, either Indian company AE gives loan to the assessee, Indian company or the foreign company PE in India. Either the AE in the foreign country have given the debt issued to the assessee, or any other person have given the debt to the AE. But in case of any other person, there must be an agreement. There must be an agreement between the AE and the other person. What is the agreement? What is the agreement? Agreement is provide guarantee. Either this AE, either this AE provide guarantee to that associate, that other person, that you provide loan to my AE in India. I am providing the guarantee on behalf of them. I am providing the guarantee on behalf of them. Or the AE has deposited the equivalent or the corresponding amount of AE has deposited corresponding amount to the account of the other person. There may be some ambiguity that there can be some reasons as well, there can be some questions as well, or there is an ambiguity in the practical life as well, that what is that corresponding amount means. Some say the equal amount. If it's equal amount, then only we will consider that. But some says if any amount is repatriated from AE to other person, then also we will consider it as the AE has deposited the corresponding amount. So both the views has taken by the I say always solve with both the alternatives. So you are free to choose whatever alternative you want to take, whether you want to take the corresponding amount or whether you don't want to take the corresponding amount in respect of such debt. I hope it is clear. There is an agreement between two persons for providing a guarantee or depositing the corresponding amount. If it is so, then the government is saying we are deem it debt from the AE by borrower. He is a borrower. It will be deemed that the AE has given you a debt. You have deemed debt from AE by the borrower. This is the borrower or this is the AE. So it will be deemed as this debt will be deemed as a deemed debt, or if it is a deemed debt, then claims interest of more than 1 CR in respect of such debt in a previous year. If the borrower is claiming interest, if the borrower is claiming interest of more than 1 CR, then we will apply the limitation of interest. Then we will not say that you are whatever the amount you are giving to the for whatever the amount you are giving in the interest, we will apply we will assume that it is correct. The government is saying no. If you are taken loan from your AE, then must not be at the arm's length price. We will let you know whatever kind of ALP that you can use. So the excess interest, whatever the excess interest shall be disallowed in the previous year, it shall be disallowed, but can be carried forward for the next year, but will be subjected to the limit. Whatever the limit is, will be subjected to that limit. He will be allowed to carry forward all his we will be allowed to carry forward all as excess interest, whatever the excess interest is. Now, what is the excess interest? Excess interest is total interest to the AE. What is the total interest to the AE that the interest has been paid to your AE? That take that amount. Okay. Now, what it says? Less 30% of the EBITDA. EBITDA is earning before interest, taxes, depreciation, and amortization. Before that, take the 30% of that and just less it. Now, whatever this is the excess interest that you have paid to your AE, that you have paid to the AE. That excess interest shall be allowed to you to carry forward. If there is any carry forward allowed, then carry forward will be given to you up to the subject limit of 80 years. Okay, is this one clear? Now, what is section number 94B? Now, when the cases of section number 94B shall not be applicable, assessee is engaged in the business of banking and insurance. If our assessee is engaged in the business of banking and insurance, then what? Then the provisions of section 94B is not applicable. Interest paid in respect of a debt issued by a lender, which is a PE of non-resident engaged in the business of banking in India. Okay, if there is any banking or insurance businesses, just do not apply the limitation of interest, because their work is only that lending and borrowing of money. Now, NBFCs as may be, this is your amendment, that the NBFC as may be notified by the government. If there are any NBFC that the government of India notifies that it for that NBFC is also the section number 94B, the limitation of interest will not be applicable, then those provisions will not also be applicable. This is your whole secondary adjustment, and this is your whole everything that we have covered, not exceeding 1 CR 15 16. Then the quantum that we also discussed. Now, this part is we are discussing right now. We have discussed everything. See, 3.25%, 3%. We have done some. We have done everything. Okay. Now, limitation of interest. Just one more point in this. One more point in the secondary adjustment. If in the secondary adjustment, if you do not want to give the interest, or the interest meter is started and you do not want to give the interest, so the government is saying just pay the ad hoc tax. What is the ad hoc tax? This is on the primary adjustment. On the primary adjustment, pay 18% flat tax, 12% surcharge, and 4% cess. In every case, this is the rate. So the effective tax rate is 20.9664%. If you pay tax on this, on the 50 crores multiplied by 20.9664%, if you pay the amount to the as a tax to the government of India, then from such date when this amount has when the tax amount has been paid, from such date that interest meter will be stopped. But until you pay that amount, the interest meter will not stop. You have to pay the interest as well. I hope it is very, very much clear to you all. We have completed the 94B as well. Whole thing has been completed from here. You do not need to even study if you have noted that the chart. Okay, now we are coming on to the last point, last 2 or 3 points of the CBC. Before that, we are just completing the rule number 10 CB. What it says: computation of interest income pursuant to the secondary adjustment. Before, for the secondary adjustment, we have saw that you have to pay the interest or the SBI rate plus 3.25% of the LIBOR rate plus 3%, whatever the interest rate comes, you have to pay on, you have to pay interest on that amount. This is so from where the interest is applicable. So see, where a primary adjustment of the transfer price has been made suo motu by the assessee. If that primary adjustment of the transfer price is made suo motu by the assessee, so from the due date of filing of return, what it says, excess money should be repatriated to India within 90 days from where the excess money should be repatriated to India. It must be repatriated from the due date of filing of return to India. 90 days will be counted from the due date of filing of return of India. Now, from where the interest will applicable, interest will also be applicable from the same date. I hope it is very much clear. Now, where the primary adjustment to transfer price made by the assessing officer, appellant authority, has been accepted by the AE, the date of order of assessing officer or appellate authority the same. If there is a primary adjustment done by an assessing officer or any appellate authority, and that has been accepted by the AE assessee, that has been accepted by the assessee, then from the date of the order of the assessing officer or the appellate authority, you have the 90 days to repatriate that amount in India. If you haven't repatriated within 90 days, so from that particular day only, you will be charged the interest. Now, what it says, whether primary adjustment of transfer pricing is determined by an advance pricing agreement. It is said what, from the advance pricing agreement. Okay, so what it says, if the APA has been entered into due date up to the due date of filing of return, the due date of filing of return under section 191, and the sorry, it must be date. What it says, from the date of filing of return, from where you have filed your return, this is till here, you have to repatriate it, because you know now the AP has been entered and you have filed your return of income on the time. So from the day when you have returned, you have filed your return of income, you know what is the amount to be repatriated to India. So it is the date of filing of return. Now, from where the interest will be chargeable, interest will be chargeable from the due date. Here only the difference comes. Otherwise, everything will remain the same. If the AP has been entered after the due date of filing of return, if it is after the due date of filing of return, so the end of the month in which the AP has been entered, from that date you have 90 days to repatriate it, and from the same date the interest method will also apply. Where the assessee has exercised option as per the safe harbor rules. For the safe harbor rules, if they apply for the safe harbor rules, then the due date of filing of return will be the date from where you have to repatriate the amount within 90 days. If you haven't, then the due date of filing of return is the date from where the interest meter will start. Now, where the primary adjustment to transfer price is determined by a resolution arrived under the mutual agreement procedure under the DTW of section 90 or 90A. There is a mutual agreement procedure under section 1990A of the DTAA. So if you'll see the model tax convention chapter, you will understand what is the mutual agreement procedure is. If that is the case, the date of giving effect by the AO under the Rule 44H of such resolution, from that date where the AO has passed the order giving the effect to the mutual agreement procedure. From that date, you have 90 days to repatriate that amount to India. If you haven't, then from the same date, the interest meter will apply. Everything here you have completed 18% plus 12% plus 4% as well. Now we are moving towards the last 2 points of this chapter. After that, we will be completing this penalty, and our chapter will be completed. What it says, see, CBC. What I said, country by country reporting. There may be an MNCs who is operating in more than one country. So all the reporting will be done by a parent company. Okay, all the reporting will be done by a parent company in their home country. Is this point clear? If the parent company is reporting, if parent company is reporting in their home country, then all other countries under the DTAA will have the benefit of exchange of information, and they will exchange all the informations required to any other country as well. So this is why there is a country by country reporting is applicable. The CBC report is submitted by parent entity of the international group to the prescribed authority in the country of resident, the home country. Okay, this report contains the details of multinational group of each country in which they do business regarding income tax, employee details, capital employed was divided by capital employed or assets, or the profit before taxes. If the parent entity is resident in India, then such Indian resident entity shall be required to furnish CBC report. Then such Indian resident company shall be required to furnish CBC report to joint director informs under form number 3CEAD within 12 months from the end of the relevant accounting year. If the parent entity is in India, then the CBC report to be furnished to the joint director within 12 days from the end of from 12 months from the end of the relevant accounting year. It says the accounting year, not the financial year, because the financial year to each countries differs. There may be a financial year from June to July. There may be sorry, July to June. There may be some other financial year like January to December. There may be other financial years as may be notified in their country. So the government is not taking much headache of issuing the financial year. They said the relevant accounting year. Accounting years everyone's same. Now, CBC reporting is mandatory if the consolidated book revenue of the last year exceeds 6,400 crores. CBC reporting will only be applicable if your last year revenue, group revenue, is exceeding 6,400 CRs. Okay. Now, constituent entity of a multinational company resident in India shall be required to furnish CBC report. What it says? Earlier it says the parent entity. The parent entity will file the CBC report. Now they are saying the constituent entity means the entity which is under the parent entity, which is under the parent entity of the multinational company who is a resident in India. That constituent entity means the small entities which is resident in India shall be required. In some cases, these can also be required for filing of CBC. What are those cases? The parent entity is resident of the country where no obligation to file a CBC report. If there is no obligation to file CBC report, then how will the parent company will file the CBC report in their country, of residence? They cannot file. So the government of India is saying any country, any constituent entity which is resident of India will file the CBC report in India. Now, the parent entity is a resident of a country with which India has no information exchange agreement. What I have said, the other countries will take all the information from the DTAA exchange of information agreement. But if there is no information exchange agreement, then what will happen? The government is saying that only if there is no exchange of information contract, then the constituent entity will file what? Will file the CBC report and not the parent entity. Now, in case of a systematic failure, that the parent entity denied to share information, if the parent entity country denied to share the information, this fact shall be intimated by the by JDIT to the entity. If that country denied to share the information, that the JDIT, Joint Director of Income Tax, shall inform the entity, and such entity, that such constituent entity, shall file the CBC within 6 months from the end of the month in which systematic failure has been intimated. Okay, I hope this point is also clear. Now coming to the master file. What master file is? Master file will have every kind of information. Every kind of information will be available in the master file. Master file list contains of all entities of the international group, their address, legal status, ownership, list, and brief description of all the important points. Now, master file shall be furnished by constituent entity resident in India up to the date of filing of return. Up to the date of filing of return. When they are filing their return, it must be given to the government by that constituent entity which is resident in India up to the date of filing of ROI. Master file is required to furnish if the consolidated group revenue for accounting year exceeds 500 CR. If it exceeds 500 CR and the aggregate value of all the international transactions during the accounting year exceed 50 CR. If the aggregate value of the international transaction, if the group revenue exceed 50 CR, okay, and the aggregate value of the international transaction exceed 50 CR, then this is the first point. Then it will master file will be applicable if this point is not satisfactory, then or purchase, sale, transfer, lease, intangible property exceed 10 CR during the accounting year, then also master file is applicable. So take this and this in one line, that this and this both 550 CR provisions shall apply in one, because it is the end. Then or it says or this. Is this point clear? This point clear? Master file is to be furnished to JDIT in form 3CEAA, and documents should be kept and maintained for the 8 years from the end of the assessment year. I am really very sorry. Listen, this is the first point. Aggregate year, accounting year exceed 500 CR, and these are the two choices. Either your international transaction exceed 50 crore, or the purchase, sale, transfer, lease, or intangible asset exceed 10 crores. If these are the cases, then only the master file will be applicable to you all. Is this point clear? I hope it is very much clear to you all. Now coming on to the last point, that the assessee is constituent entity of an international group, and he has to maintain, that we have just seen, that he has to also have to maintain the books, have to maintain the information and documents. If he haven't kept that information or the document prescribed, then what will happen? And if furnish prescribed information to the prescribed authority up to the prescribed date, whatever the prescribed date the authority will say. If it furnished prescribed authority the same under the prescribed date, then what is the this is the provision that you have to apply. If it not, let me check what is. Again, listen to me. Is the assessee, if the constituent entity, if the constituent entity of an international group, the provision is what? This is the provision. Also, keep and maintain the prescribed information and document in respect of the international group, and such document, such information shall be prescribed. Such prescribed information is to be furnished to the prescribed authority up to the prescribed date. If that is the case, and if you have if you have failed to furnish such information, if you have fails to furnish such information, that the penalty is rupees 5 lakh rupees. Then that the penalty is rupees 5 lakh rupees. I hope this whole chapter is also clear to you all. The transfer pricing is very much easy chapter. Just you need to focus on the secondary adjustment. You need to focus on the limitation of interest, and you have to focus on the sixth method. These are the most important part. Then the B category topic is the APA and the rollback. These are the 4 to 5 topics that you have to keep in mind. Otherwise, all the chapter is just easy and easy. I hope you all have understood it. You all have enjoyed the lecture. Now if you have any query, any feedbacks, you can just write in the comment box. I'll try to answer all those as soon as possible. Thank you so much for watching. Let's meet for the another chapter. Thank you so much.